So when I hear poor people say to me, I don't have any money, I said, because you're an idiot. That's why. If you want to be poor, I hate to say this, you can go to school. I'll give you another tip. If you're going to be rich, you have to learn to use debt. It's called other people's money. You're not supposed to use your money. You're supposed to use other people's money. But that's debt. I don't want to do that. And so they stay poor. In 1997, when I released Rich Dad, Poor Dad, that book caused a bit of an upset because I said, your house is not an asset. So in today's world, if you want to be rich, you have to know the difference between assets versus liabilities. One of the reasons so many people are struggling financially today is simply because they're calling their liabilities assets, such as your house is not an asset, your car is not an asset, and things like that. So very simply, when I was a young boy, my rich dad taught me, he says, you have to understand a financial statement. So this is an income statement, this is a balance sheet. Now this is overly simplified. He says, what creates something to be an asset is very simply assets, cash flow money into your pocket. And a liability takes money from your pocket. So for most people, their houses are not assets or liabilities because every month it takes money to live in that house. Even those who say, well, I don't have any debt on my house, I've paid it off. Look, you still have insurance, still have upkeep, you still have maintenance.
I make my usual wise-ass remark, only lazy people use their own money. And that's because I have spent much of my life raising capital. Today you have crowdfunding and all that stuff. But the reason I had to learn to raise money was because I had no money. And so if you read Rich Dad, Poor Dad, in there, my rich dad always said, never say, I can't afford it. And it was my rich dad and many of my teachers subsequent to that. They said, lazy people always say, I can't afford it. I don't have the money. That's why they're poor. They have a poor mindset. So instead of figuring out how to raise money, it's just really easy to be a loser. And I call it losers. It pisses them off. Because we all have the power, if we wanted to not be poor if we learned how to raise money. So I hear, and the reason I get upset, I still get hot like this. My poor dad, my PhD father, he always said to me, he says, I'd be a rich man if I didn't have you kids. And I said, well, Dad, it's not my fault you had kids. I just can't afford it because I have kids. And the more he said that, the angrier I got. So when I met my rich dad at age 9, he says, well, that's why your old man's poor, because he's lazy. He thinks his PhD is going to carry him. He says, everybody can say, I don't have money, I can't afford it. He says, that's why he's poor. He's lazy. But my father kept going back to school, Stanford, University of Chicago, Northwestern. He never learned any of this stuff. They still don't know it because most teachers want a paycheck, pension, and tenure. They want job security. So the mindset is different, and that's what they teach the kids. There are 6 basic words to financial literacy and financial education, and the 6 words again are income, expense, asset, liability. And the secret to being rich is not a college education, but can you control cash flow? And this is what cash flowing looks like. So this here, you need this, income, expense, asset, liability. Again, this is, you get a job. And this was my poor dad, go to school, get a job, get your PhD. And so this here is cash flow. So income comes in, and it goes out this way. First line of expense is tax. So this is a poor person's cash flow pattern. It's not how much money you make. Most people, I don't care if you have a PhD or no school at all, but they can't control the cash flowing out through their expenses. And so that's why people like Susie Orman say, cut up your credit cards, live below your means, because you're a spendaholic. So that's a poor person. This is a middle class person's cash flow pattern. And this is where the house comes in.
they, first thing, most kids do when they get pay raise and all that, they buy themselves a bigger house. Oh, my house is an asset. Now, who tells you that? Your real estate agent, of course.
Yeah.
Right? Because they want to give you this false sense of security while you're getting screwed.
Exactly.
But when you look at what happens with a house, a personal residence, something I live in, the money comes in and goes out, and this is middle class, but it also goes out through a mortgage payments. Oh, but I don't have a mortgage. You still have taxes. You still, Hawaii just raised the property taxes on me, which is probably what I'm going to sell. I'm going to get out of Hawaii. But you have taxes and you have upkeep. So money's always flowing out. So that's why your house is not an asset, is because it's taking money from your pocket. So very simply said, assets put money in my pocket, liabilities take money from my pocket. And then this here is, so I'm not saying don't buy a house, but here is a house. And I started when I was 25, bought my first house, and it was an apartment, it was an investment property. I didn't live in it, I rented it out, and it put money in my pocket. So very simple, the definition of asset and liability is not the house or this, it's cash flow. Where is the cash flowing? So as a young person, and to all millennials or if you're old, financial intelligence is the ability to control cash flow. And that's what they don't teach you at school. They tell you to go to school, get a job. First thing is tax. You'll pay, most of your money will go out through taxes in your lifetime. And then they tell you to buy a house and a car. A car is an asset. No, a car is a liability. You got insurance, gas, upkeep, and all this. Now, if you buy a taxi car, it could be an asset. It's cash flow. And that's very simply it. So this is a poor person. Money goes out. There's a lot. We just interviewed some National Football League players who make millions of dollars in their 20s. And most of them are broke in 2 years because they can't control cash flow. Intelligence, IQ, is can you control cash flow? Not your college degree. College degrees are important, but they're not going to teach you this. So the cash flow game trains you over and over and over and over again to get your money in here to get cash flow this way. So I started with this. Cost me $18,000. I paid for the credit card and I put $25 in my pocket. Okay? It's an infinite return because the cash flow paid for the mortgage, it paid the expenses, pays the operating costs, and I still made $25. Kim's first deal was the same. Hers wasn't $18,000, it was $45,000. And they put $25 in her pocket. But Kim now owns 6,500 rental properties, and she pays no tax because the income comes from here. Mm-hmm. If you have a job, you pay tax, but income, the rich get richer because when you have asset income, taxes are less. You can get it down to zero if you want. But that's financial intelligence, but can you control cash flow? So that if, as a young person, as your parents get older, the question is, can I afford to spend $20,000 a month on my mom or my dad's long-term health care? Yes or no? No. So, and this is going to happen to my generation. Many people don't realize, but their brothers or sisters' kids and all this become liabilities for them. So as a person who's fairly well off, and Kim and my friends are thinking about two-legged liabilities. So I know today that if my sisters become ill, I'm the one with the money, and it's my responsibility to pay for them. Same as my brothers and their kids. So these are things that people don't think about a lot of times, is what happens not only as they grow up, but what happens as they age. Statistics show the average person, like my generation, let's say have $1 million, 80% of that $1 million will be gone the last 2 years of life
because medical expenses go through the roof. And today insurance companies are canceling, I forget the name of it, but my friend's mother, it was just canceled. So he doesn't have $18,000 a month. So he had to bring his mother into his house and create another room and all this. He said, well, I love her, which he does, but she's a big liability, and all he had was savings. So the savings are being depleted going out this way. Okay, so but your question about houses and people, but people are assets and liabilities. And so for me and for Kim, we have family members, but they're liabilities. So that's why we stay over here. Hopefully nothing will go wrong. But if one of my sisters got ill and she needs $100,000 a month, at least I can provide it.